Hello, legends. Today, I catch up with Cub member George Hadjia, the founder and CEO of Bristlemoon Capital, which is a global equities firm. George is an incredibly impressive guy. He's only 33 and he's set up his own successful hedge fund where he manages the investment capital of many high net worth individuals. In this episode, we discuss the psychology of investing, like things to do and not to do, and just the traps to stay away from. His experience in New York and how him living there impacted his life and his business, the importance of holding cash as an investor and business person, and basically stocks versus other asset classes. So why invest in stocks as opposed to property, which for me was something new. George is a really cool guy. Enjoy the show. Hello, everybody, and welcome to today's show. Before we start, I am going to read a little disclaimer. The information contained in this podcast is not investment advice, but for informational purposes only. Listeners should obtain independent financial advice before making any investment decisions. Now that we got that out of the way, welcome to the show, George.
Thanks, Daniel. Good to be here.
Good to see. Are you Lebanese?
No.
What's Hadjia?
Half Greek Cypriot.
No
Hadjia.
way.
Yeah.
So how do you say your last name?
Hadjia.
Hadjia. Oh, fuck. I was real off.
That's all right. Some people get it, off the bat.
Hadjia.
Other people, a few attempts.
So Greek Cypriot. Why are so many... Cyprus is right next to Greece, isn't it?
Yeah, it's close to Lebanon as well.
It is? Oh, yeah. You're similar to me then.
Yeah.
And George, I'm excited to actually talk to you because A, we've never met, but B, you've started your own fund, your own global equities fund, basically, which sounds like a very difficult thing to do, especially for a really young guy like yourself. How old are you?
33.
Yeah, so real young. And so I guess let's start with, how does one go about starting their own investment fund?
Yeah, there are a few gating factors to getting a investment fund off the ground. The first is regulatory. So to manage external capital, you need an Australian financial services license. So you can either rent one from someone and pay them money, and you create a business dependency on that person or that firm, or you can obtain your own. And it's a pretty rigorous process, and you do that via ASIC. And for us, it was roughly a 6-month process to get that approved. The second part is capital. So capital is the lifeblood of a funds management business, and it requires a great deal of trust with prospective investors to get them over the line, to have them back you. And the third part is just really the operational side, and picking service providers, determining how you're going to structure your fund and manage also the portfolio on a day-to-day basis.
But so what made you want to get into funds management?
Yeah, so I'd done it my entire career, and we could go back and say how I got interested in that. It really started as a kid. I'd sit down every Sunday and watch Inside Business with my dad, and he used to do a lot of investing. He still does, and it just sparked this curiosity. And then I remember reading Warren Buffett's biography, and that really got me on this path of reading all these value investing books.
What's it called again?
Well, there's a few, but the one I read was The Snowball by Alice Schroeder. Yeah. Yeah, and it was this light bulb moment for me, and I said, that's what I want to do. And I was 18 at the time when I read it. And, throughout uni, I did a few internships, unpaid work experience, 1 to 2 days a week at an investment firm. And that converted into a graduate position. And so through my entire career, I've been at funds, and it got to a point where there was a desire within me to build something. And not only that, but to have control over how I invest, investors' capital, as well as the decisions around building the business. And I felt where I am now is a point where I'd had enough experience, but then still had that hunger and energy to build a business.
And so what you wanted more kind of ownership over the investments, as opposed to working at a fund where you're kind of more actioning someone else's strategy.
Yes, somebody above you, and this is true for really any employee-employer relationship, they have veto power over your decisions. And that's something, and it comes down to your personality type as well. I'm somebody who likes to have autonomy, and it got to a point where I was curious. I said, I think I could have a crack at building this, and I set off on that path.
And was your old man in business as well, or what was, I guess, your example of? I always find that often if someone has a great example of someone who kind of has demonstrated the fact that you can build your own thing and has even encouraged that person to do it, you're a lot more likely to do it. Was that the case with your old man, or did you have someone else in your life that kind of paved the way?
Yeah, so not so much my dad. He's not someone who started his own business and went down the entrepreneurial path, but I'd say one big catalyst or something that inspired me was I lived in New York for 5 years, and when you are in a city like New York, you're constantly exposed to the hungriest, most ambitious people. And I can't tell you how many people I met who'd started their own businesses, a lot of people in their 20s who'd started their own hedge funds. And seeing that, it makes you think, okay, that is something that is possible. It's within the realm of possibility. And seeing those other people take the leap, and they were very encouraging as well. One friend, she's done unbelievably well, and she said to me, "Why haven't you resigned already?" And it's just this different mentality, and being exposed to that, I think, was beneficial.
Yeah, that's the power. That's the power of travel.
Yeah,
I love going to South France because I feel real poor. Yeah. I'm like, far out. I could be doing a lot better. Like, I could do more. Like, it puts things in perspective. And it also shows you a bunch of people, all the most successful people in the world are all in the same place at the same time. Yeah. So you're basically in an environment where, trying and attempting to do well in life and actually achieving it as well, that's the norm. Yeah. The other side's not the norm. And New York is that constant. New York's the epicenter of the world. Like, I remember the first time, every time I go to New York, but the first time particularly, when you're driving up to Manhattan and you see that kind of giant wall of tower, like it's kind of like you're driving to King Kong's house and you're like, wow, like you feel small. Like, yeah, I love that feeling.
There's this feeling, after I moved there, you'd travel out of the city, and whenever you'd go back in from JFK, you'd see those lights and you'd get this feeling. And the city's like a magnet that keeps pulling you back. And I don't think, if you've lived in the city and you love that place, you can never really leave New York. Yeah. You'll always want to be going back.
Yeah, isn't it special? But I guess it depends on who you are. Because, if you're someone who wants a more laid back, you can live life great in any way you like. But if you're someone who wants to kick back, chill, a bit more like the Cypriot lifestyle.
Exactly, that's a good example.
If you had that lifestyle, you're probably not going to like New York.
Yeah.
But if you throw someone like us, or I'm sure most of our listeners and definitely all the Cub members, if you put them in New York, like, you could very easily light a fire that's not going to burn out easily. That's going to try and grow.
I think that's the benefit of the city as well. It's very self-selecting. So many people that you meet in that city aren't New Yorkers. They're from other parts of America, other parts of the world. But the reason why they're there is that they uprooted their life to move to New York for the opportunity there, to progress their careers, to make more money. And it's an expensive city. If you're living in Manhattan, it is an expensive, tough place to survive. And so it kind of weeds out
the weak. It's literal survival of the weak, survival of the weakness, survival of the fittest.
Yeah, totally.
New York is that in every sense, especially the business sense, because if you want to go compete there, if you want to compete in business in New York, you're competing with the heavyweights.
Yeah.
There's no lightweights and middleweights. Like, you're going straight in to the heavyweight division, and like, you better be ready for that.
Yeah, I just remember you'd go to a friend's party. They'd say, hey, having a rooftop party, come through. And the people you'd meet there, it's almost like unanimously they would all be doing really cool things. They've either started their own business, or they're at a top hedge fund, and then the conversations you'd have were just so rich and interesting. And you're just really being exposed to these high caliber type A people. Yeah, totally.
Yeah. And like, life is who you surround yourself with. Like I said, there's no right or wrong way to live life. But if you want to live a big life, surrounding yourself with other people who want to live big lives and, uprooting their life and moving to New York is probably the ultimate, it's kind of like a members club. It's like, that's your buy-in. Like you've got to move from wherever you are to New York, and now you've entered the club of like ambitious people trying to do good things in life.
Yeah, and to be frank, that was part of my motivation when moving back to Australia a year ago for joining Cub. It's, you're always trying to find your tribe, find those people where you're on the same wavelength, you can connect with them and talk business or whatever it is. And I feel like Cub has been incredible for that.
Yeah, I mean, Cub is like a little New York in Sydney, Melbourne, Brisbane.
I think that's a good way of putting it.
Like it provides you that energy. A lot of people after a Cub event, they'll come up to me and be like, whoa, like, the energy that you get from listening to people and listening to what they're doing, they're like, it's almost motivating. It makes you want to do more. Like, it works so well. And so how old were you when you moved to New York?
I was 27 when I moved over there.
And was it for work? I assume it was for work.
Yeah, so the backstory was I started my career at an investment firm based in Sydney. I was there for almost 2 years, but my desire was always to work in New York. And what I did was I emailed dozens of New York hedge funds, my resume, some research reports. One got back. I was like, well, that's not very good. So I ended up flying over there with a stack of these research reports and my resume. And I ended up knocking on the doors of these hedge funds, going around Midtown in Manhattan and trying to, get a foot in the door and get in front of someone to tell my sob story about how I'd flown all the way from Sydney to New York. So I was doing that. I was going around Midtown, and basically I'd get to the front desk and they'd say, do you have an appointment? I'd say no. They'd say, well, we can't let you up. I was like, well, this isn't going very well. There was one firm where I was able to get up there and started talking to a partner, and he mentioned one of his friends who was starting a hedge fund in Sydney. And then a few weeks later, when I was back, I connected with Andrew Macken, who was starting Montica, and I joined in the startup phase as an analyst. So that was in 2015. Then 3 years in, I moved over to New York to set up the New York office for that fund. So we had, the Sydney, the New York office, and I was based in New York for 5 years.
And so that's why you were in New York. You were setting up the Australian fund in New York.
Yes.
Very cool. That would have been an amazing experience.
It was really cool. It was very, very fun.
What was the most difficult part about setting up an Australian business in New York? I asked you that as someone who wants to, our international expansion for Cub starts in 2027. BOA could be much before that. So I'd be very curious, like is there a culture shock, or what are the major challenges in starting a business in New York?
Yeah. I'd say from the get-go in 2015, when the fund was structured, it was a Cayman master fund structure. So it was all done to future-proof it so that when the New York move happened, we could raise US dollars from investors.
Do you want to just explain what the Cayman master fund structure is?
Yeah, so if you've got an Australian unit trust, like an Australian vehicle, it's less attractive to, say, US investors. My understanding is there's tax implications. They prefer either a US like a Delaware entity or a Cayman vehicle, just for tax reasons. I'd say the other part, which is challenging, could be visas. If you're getting Australians to go over to America, we're actually unbelievably lucky because there's an E3 visa that's specific for Australians. So we don't have to go into the H-1B with the rest of the world for the visas. I'd say those are the main things. Culturally...
that sounds like a positive. Is it harder that you're starting a business in the Big Apple? There's a lot of big apples there. There's a lot of big businesses. How were you able to raise capital as a new fund in New York when there's so many established funds of whom have huge reputations and long histories in successful returns for their clients?
Yeah, it's a good question, and I think that was a difficulty and a headwind. So all of our AUM at the previous fund was Australian based, and the challenge was you would go to New York and no one would know who you are, and then you're competing with hundreds of funds in Manhattan alone. So I think that was something that was challenging and humbled us somewhat, because you don't know what you don't know. When you're in Australia, you say, oh well, we can just go over there and set up and then raise some money, but it probably fell short of expectations.
Yeah, well, it's just harder, I guess.
Much harder.
And so what made you come home? Did you stop working at that business, or they withdrew from the US?
So that they're still there in the US. I resigned in April of 2023, and my plan was I'd move back in July to Australia. And then the reason why I was in two minds. I said, should I set up the hedge fund in New York or should I move back here? And for some of those reasons we're talking about, just the level of competition there, it's really hard. And then you've got the visa issues. So if there was something that went wrong on the visa side and you have to leave the country, that's obviously very bad. I feel like Sydney or Australia in general is a great place to start a fund because there's relatively less competition, but there's still a ton of money in Australia. And I've got family here, and it just felt like it was time to come back.
I agree. When you start a business, going to the biggest market isn't always the best decision. You know, often you have to look at, okay, what's the playing field what's the field I want to play in? Like, what I love about Australia is that it's still an empty country. Yeah. There's no one here, literally no one. And it's a very sophisticated country. So it's a country where, you know, you can, I mean, in my opinion, there's way too many regulations and it is a bit of a nanny state. But outside of that, it is fairly easy to set up a business, to get everything operating. Like, the rules are fairly clear. Like, it's a good place to operate. But I think it's one of the unique places in the world. It's safe. If you want to do business in like Mexico, you know, where my mum's from, so I can say that. But if you want to do business in Mexico, it's a very different story, or like Africa and all the, like, really most of the world other than a lot of the Western countries. But it's a lot more difficult to do it. You know, there's not just the actual laws, but there's the business laws of the people that currently are in power and things. So Australia doesn't have much of that. It's a much cleaner place to do it. And it's one of those unique opportunities where you can actually own an element, like you almost own an industry or a large part of it, because they're not hugely dominated. And there's a lot of new industries coming. There's a lot of new ideas that you might see in America that aren't in Australia, or you might see in Europe that aren't here. You know, like, it's like, would you rather be a small fish in the biggest pond or a big fish in, still, like, it's a small pond, I guess, but it's a nice pond. It's got views and it's beautiful. It's a nice place to hang out. You know, there's good lily pads to sit on, to tan. Like, so, you know, the question is, like, do you actually have more strategic advantage in Australia than overseas? And even more so, like, I had this conversation with a Cub member the other day who lives in Newcastle, and he's telling me he's got hospitality businesses in Newcastle. And he was saying, I don't know what I should do. Should I leave Newcastle, whatever? And my advice was, mate, if I were you, like, there's a lot of already competition in Sydney. There's a lot of big players, there's, you know, in Melbourne, Sydney, everywhere. You could be like a key business figure in your area, in Newcastle. Yeah. You know, you could own hospitality in Newcastle because that's still up for grabs. You know, it's not saturated. Yeah. So even when you look outside of a country basis, you can also look at a city basis. Like, where's the next up and coming city, you know, that I could be a dominant player in, and that the population is going to grow. And if I stay here and I master here and I build my network here and I build my reputation here, I can own a large element of an industry in this location.
Yeah, you know what I mean? And the beauty of a hedge fund is that you can work from anywhere, and down the track, you still have that option to raise money from US investors. And so one thing that I did, it was around a year ago, I launched an investment newsletter, because if you think about it, I spent 5 years in New York, and that was 5 years away from Australia, and that was time taken away from building my network here. So coming back, there's almost a trust and credibility problem. You know, if you're trying to raise money from people who've only recently met you, they're thinking, is George credible? What is his investing aptitude? Can I trust this person by, you know, writing them a check? And so the newsletter was a way to showcase the sort of work that we do. And it's scaled quite well. So we have almost 3,000 subscribers now a year later, and there are readers in 80 countries. And so what has happened is that there have been US family offices and even some in Europe that are reaching out, wanting to invest with us. but we're sort of just not set up for that yet. But it creates this option down the track that as we keep generating content, people, and you can't see how they're interfacing with your content, but they're reading it, they're looking at each article, and it's building a brand. You know, it's building that trust in their mind and shifting that process of building a brand and investor education from a one-to-one basis, which is very laborious, to a one-to-many basis, which taps into the scale and power of the internet. And so I think longer term, once the Australian business, you know, scales up to a level, there is that option to raise money from offshore.
But I think the real lesson there, though, is the importance in building relationships with people before you actually do anything with the relationship.
Yeah.
You know, it's like if you want to raise capital from a VC, well, don't go meet them when you need the capital.
Yeah.
Go hang out with them, you know, go meet them and get to know them before you need it.
Yeah.
You know, and that's what you're doing. It's more of a warm introduction, because when you reach out to these people in a couple of years' time, they already know you.
Totally.
You know, you might have even jumped on the phone with them before, or you might have they've seen all your work for the past 2 years. They're aware of you, you know.
Yeah.
It is brand building, but actually I think it's relationship building.
Absolutely. Yeah. And if you think about the nature of wiring somebody money, there is so much trust required for that. And it does take time. You know, there are some people where you can meet them and in a short space of time, you know, we've had the experience of them saying, oh yeah, we'll give you a bit of money. But then others, and there's no real way to sort of benchmark who's likely to give you money or not. It's such a random process. Others might wait months or in some cases years before they'll write you a check.
Yeah, because I mean, sending people money always sucks.
Yeah.
Yeah, you've never been like, oh, I can't wait to do this. It's always like, oh, do I have to? Should I? Could it backfire on me?
Yeah.
And you're a young guy. That's the other thing. Like, as much as that is that might be like biased, but at the end of the day, if someone wants to send money and they look at you and you're this young guy, they might be thinking like, oh, but he doesn't have as much experience as the older guy.
Yeah.
You know, so how do you kind of navigate that? Like, how do you bypass that situation?
Yeah, it's a question I get a lot in meetings with investors. They always ask, how old are you? I tell them 33. And, oh, I thought you were younger. But it's something where people are using proxies for your competence. It could be your age. It could be, do you have a city address? How big's your team? There are all these questions that seem to pop up, and they're rules of thumb for people to try and gauge, is this person legitimate or not? I think it's a bit of a balance between, you know, if I was 10 or 20 years older, yeah, you have more experience, but then conversely, you have potentially less drive, less energy to really make the business work. And so where I am now, you know, I've got all my investable assets in the fund alongside clients. I'm trying to build something, and this is everything. Like, this fund is my life. And so anyone who's backing a young person is backing someone who almost has a chip on their shoulder. They want to prove to the world that they're competent, they're good, they're going to build something. And I'm not saying that that's always the case, that for someone who's older, they don't have that. But typically what I've seen is that as people get older, they make their money, that passion and hunger can tend to dwindle.
And tell me, what type of things do you actually invest in? So are you playing the stock market, or are you investing in private businesses, or what assets are you investing in? Yeah,
so right now it's stocks, publicly listed equities, and it's global stocks. We are mostly invested in North America, Europe, and a bit of Asia. And the types of companies we're trying to invest in are high-quality businesses that we think will grow their intrinsic value at really strong rates for years to come. And so when I say a high-quality business... I was
going to say, how do you define what's a high quality?
Yeah, people throw that term out a lot because it's like putting a warm blanket on someone. They feel better if the person they've given money to is investing in something quality, as opposed to if I said, I'm investing in really low-quality businesses. There's just different ways to make money in the stock market. You can still make money not investing in high-quality businesses, but what quality does, and the way that we think about it, is it acts as like the guardrails around the future growth path of a business. It allows you to get more conviction that the free cash flow profile for that business that you're underwriting will actually come through and won't get competed away. Because if you think about investing, the value of any stock is essentially how much cash can you pull out of that as an equity holder. And if you don't invest in a high quality business, there is a greater chance that that cash flow profile will be competed away. And when you're thinking about 5, 10, 20 years into the future, it's so uncertain, so much can change. And for a really high quality business, it's one with a wide economic moat, a very competent, aligned management team, and a long runway for growth. So if you have those things, essentially, if you think about most businesses, they follow a business life cycle. They grow very strongly, they start to mature, then they decline. For the highest quality businesses, they have optionality, which is basically layering on new earnings and earning streams. I'll give you an example. Amazon, back when it started, was selling books. There was no inkling of AWS and the cloud. The cloud didn't exist when Amazon was started. But a really smart management team has the ability to unlock value that you can't really foresee today. Because as an investor, you're essentially valuing the business and assessing its prospects based on what is observable today. And that is why a lot of people tend to systematically undervalue high quality businesses, because they don't turn their mind to those options, those new revenue streams. And so it's basically layering on these new growth trajectories, which allows the total growth of that business to sustain for longer than what people are expecting.
So really, a high quality business to you is a company that has like a strategically defensible position. It's not easy to knock them off. It's not easy for a new entrant to come in and steal their revenue.
Totally.
Which brings up an interesting topic, because how does one actually do that? You know, how does a company actually create that much of a moat?
Yeah,
I think is what you called it. Can you describe a company that you've seen recently or in the past that has a good example of a strong defensible position and what made it defensible?
Yeah. I'd say an example that's fairly easy to observe and see, and it's a very, very strong barrier to competitors coming in, is network effects. So if you think about something like Meta, which owns Facebook and Instagram, Airbnb, even something like Tinder, you know, these are businesses that are two-sided networks, marketplaces, and once you get to a level of critical mass and a level of user liquidity, it becomes very expensive for somebody to try and replicate that network, because it's just too hard to offer value to pull away users from those networks.
Or too expensive. Yeah, it's too expensive to do it.
The cost is prohibitive. And so there are a number of other sort of factors. It could be a scale advantage, which then means that your cost per unit is going to be lower. And that's another one that's easy to observe. You know, if relative to
economies of scale.
Exactly.
If I can provide the same product cheaper, you can't really beat me.
Yes, correct.
And tell me, with the network effects, what was I just thinking in my head? Network effects, scale. What did you say just before that? Sorry. It was important. I want to think of it.
Meta or?
No, what was it? Oh, so with like a management team then. So you might be able to see that, okay, this company has the ability. Sorry, just thought of it. It was first mover advantage. You know, being the first, like Facebook. I guess Facebook wasn't the first social media, but it was kind of the first dominant one. Coca-Cola, you know, like Airbnb, Uber, you know, McDonald's. They're all first movers. Being a first mover and having the first brand, like kind of known brand, like owning that market position, I assume that would be a very big defensible position and strategic advantage.
Yeah, I think a really good example of that are the dating apps. So Tinder and Hinge, they both started in 2012, and while online dating had existed in a web You go into your web browser, a web form for quite a while. It was mobile online dating, which they really pioneered and were the first mover for. And
gamified, like it was different. How you were doing it was different.
It was the swiping mechanism that Tinder had. And so what they did was they went around to university campuses. It was a bit of a grassroots campaign to get people to download the app. And the growth was so viral. But to your point about why was that growth different to something starting now? Well, the first mover advantage meant that those users coming to Tinder, it was new, it was novel. The entire category was new. And that sparked that virality. It allowed them to grow at unbelievable rates. And I think about it as there was this window available to scale one of those assets, and that window is shut now. If you're trying to start a dating app, good luck to you. It's next to impossible, because what people don't realize is that Tinder and Hinge went for 3 years without any monetization. And the only reason why they were eventually able to monetize was they got to a level of user liquidity where, if you're swiping for a significant other, there are enough people to go through such that adding on value-added products that you pay for generates enough value to justify that expenditure. And so if you think about today, no one's going to fund a dating app. VCs hate the category because you've got this ephemeral user base. It's kind of high churn. So you're not going to get the funding, and you're not going to be able to bridge that gap that you need to scale up something before monetizing. So that's something that's quite a defensible business.
Yeah, well, again, it's first mover advantage. But same being said, like they innovated the dating websites on computers, soon a new market will open again for dating. That's going to be the next thing after mobile. Do you know what I mean?
It's possible with VR.
It has to. There's always got to be a next. Nothing ever stops until the world blows up. There's always got to be a next, but it's about what's the big wave, at the moment. Like, for example, maybe AI dating.
Yeah.
Like maybe it shows you the highest likeliness that you are going to get along best with this. That could be the next dating. There's always a next. It's about being the first of the next.
Yeah.
Because otherwise, everything was always done. You know what I mean? Like there's no entrance. You got to see what's the next thing. And network effect companies, they are the most valuable. So they have the most literal value. They're always valued the highest. But they are notoriously the most difficult to make succeed, because you have almost the chicken and the egg. You've literally got two sides. Do I need more? Like, I want more Uber drivers, but I need more customers. Otherwise, my drivers are going to do anything. If I have too many customers, and I have the drivers. And so starting network effect companies, the best way to do it, and I've done a lot of research on it, but the best way to do it is like what you described, is how Tinder did it, and also Facebook did it. It's about basically niching how you do it. So Tinder threw singles campus parties in all the colleges. Facebook started just for people in Harvard, and then just for people in Ivy League colleges, and then just for people in colleges. And then so having that niche entrance point is a really important way to start. It's very hard. Like Uber needs a niche. The niche was originally San Fran, and I think before that, even not just San Fran, it was trips to the airport.
Right.
That's how they originally started. So network effect businesses are known to be the most difficult businesses. But when you're doing one, to enter, you have to think really, really small, because they are the most valuable business. They're all the ones that have blown up.
Yeah, those are super interesting points. I think when you say they're the hardest to succeed, I'd say there's probably two parts. They're the hardest to start due to the points that you mentioned. There's always a hard side of the network, and it's usually the supply side, like getting drivers, for example.
Yeah, or YouTube content creators, totally. Or Instagram influencers to post relevant things.
Yeah, and so that initial period, the chicken and egg point, is very difficult. But then once you get to a point where that flywheel starts spinning, then it becomes self-reinforcing growth, and then they're actually kind of easy businesses to run, because the scaling almost takes care of itself. But to get to that point is very hard, and it does help if you're a first mover.
Yeah, yeah. I just think like, how can you be, if you're a business owner, like, how can you be a first mover? Like, Club's not the first members club in Australia, but if you to ask anyone about members clubs, or if a members club opens or there's another networking business, they always say, is that like Cub?
Yeah.
It has it's the first mover of the new generation of that category.
Well, you're relying on something different. So rather than relying on a moat, you're relying on execution. And that's what I think a lot of investors really forget, is that there are businesses that shouldn't on the surface succeed, but because of superior execution, they do incredibly well. And it's like Economics 101 says that if there are two, Thai restaurants located next to each other, they'll compete away the economic returns, and the profits will go down to zero. But that's not what happens in reality. If you've got one Thai restaurant that just cooks the best Thai food, there's a line out the door, and that's due to superior execution. And that's something that is a lot harder to underwrite from an external vantage point. If you're trying to assess a business, what is superior execution? Like, yeah, sure, it can show up in the numbers, but a lot of it's cultural. It's understanding those day-to-day processes and decisions which over time can add up and create an advantage.
How does an investor though see that then? Right, because you can see the returns of the business. You can see what they're doing with their marketing and their brand because you can visually see it.
Yeah.
How does one and management plays such a big role because, like you're saying, you as an investor might see potential future revenue for that company. But if that management team doesn't feel like that is a viable or strategically aligned option or path, you're never going to get that. So how does an investor understand what's going on in the minds of these companies?
Yeah, it's part of the diligence process. Everyone's sort of crunching the numbers, and you can look at that. But talking to former employees, talking to competitors, talking to the management team themselves, and you're trying to assess what is their strategy, and then figure out how well are they executing on that. And it is tough because when you're investing in public equities, there's an informational asymmetry. You don't have complete information. And a lot of the time, I'd say almost all of the time, when you hear presentations from these companies, they're highly engineered to sound positive.
Well, obviously.
This is how the world works, right? And so I think that the hardest part of my job is essentially cutting through and calling BS on some people. And that's why, when we're shorting companies, we hear some of the rosiest stories and we say, well, actually, no, that company could be worthless one day. We're going to short it. And I think having that ability to short companies gives you that intellectual honesty, which can help you when you're buying investments on the long side as well.
So, I've never invested in the stock market. It's just not my area of expertise.
Yeah.
But I've read a lot of books, including all Warren Buffett's books and biographies and everything. And what's the big book he loves? He didn't write it.
Security Analysis, Intelligent Investor.
Yeah, Intelligent. Is that the red one? It's a red cover. It's called the one about value investing or something. It's a red cover.
The Ben Graham one.
That's the one.
Yeah.
Yeah. So I've read all those books. And one thing that the most obvious thing that you remember after reading them is that investing is actually quite simple, but it's a lot of psychology. Yeah. So when things are cheap, everyone's selling. Well, that's when you should buy. When things are expensive, that's when you should be selling. That's when everyone's trying to buy. So it's just kind of doing the opposite to what everyone's doing. And in addition, investing into companies that have strong fundamentals and whatnot. But a lot of it is just the psychology of other investors. How do you as an investor control your desire to follow stream? Oh my God, everyone's investing, I'm going to freak out, and everyone's selling, I'm going to freak out and sell. Or should you be buying at that time? How do you personally, how do you manage those impulses? Because obviously you're an investor, but you're still human.
It's a key question, and that is one of the most important parts of the job. And part of it is innate. Some people are predisposed to being swayed emotionally by external forces. They are predisposed to not trusting their own judgment and opinion. And so it really helps to have that staying power when you've done the work, you've done the analysis, and you have conviction. Because when you have conviction, you're basing your view on something tangible. Okay, you know why you've invested in that stock. You're playing for a future outcome. Just because somebody tomorrow or the market as a whole tomorrow disagrees with you isn't really going to cause you to abandon that view. Now, where it gets a little murky is if new information comes to light. That means that view might have changed. And so that makes it a little harder. But really, you need emotional fortitude when you're investing. And a lot of people think, okay, well, if so-and-so is really smart and does really good analysis, that's all you need. I would say that those attributes are secondary to having emotional fortitude, because if you don't have that courage and conviction, markets are volatile. They just are. It's like the price of admission to getting those good returns is interim volatility. And what will happen is that during those inevitable bouts of market gyrations, if you don't have that courage, you're likely to sell at an inopportune time and undo all the good work and analysis you've done. Basically, if you're selling at a silly time because you panic, it doesn't matter how good your analysis is. And so for me personally, I don't think I'm a particularly emotional person. So
yeah, I don't think I do so well. The only thing I do well at...
It's good that you recognize that, though.
No, the only thing I would do well at is when everyone else is selling, I'd want to be different than everyone else. I always like to be different. I'd start buying, So I'd probably win by default.
But that's dangerous as well, because when investing, you need to be contrarian, but you also need to be right.
Yes, but you only need to be right if you don't have cash. Because if you have cash, right? I mean, I'm just following Warren Buffett's book. But if you're holding for the long term, you're not holding for this cycle or the next cycle or the one after that. You're holding because the company's got good fundamentals, is going to perform, and the market's going to grow over time.
Yeah.
So therefore, there is no reason for me to sell ever unless I need the cash.
Yeah.
So if I have a lot of cash, I don't care to sell. I don't even care what the market's doing because it's there for 10 years or much, much longer in his case, for example. So like one thing that COVID taught me was, because we didn't used to hold cash, like Cub, I'm talking about Cub as a business. Before that, we were in rosy times. Like, I had never experienced running a business through any sort of crisis.
Yeah.
Because it's from 2015 to 2020, it was pretty much smooth sailings. COVID was the first time I was like, oh shit, is the business going to survive? I've got all these staff. I've got to pay all these rents. The first time in my life, I was like, holy crap, now I know why it's important to hold lots of cash, to not spend your money. And from that point, I took that really seriously. And I mean, Cub did really well at that time. That's actually when we really took off. But the point was I had learned that lesson. It was a good lesson to learn. And so now, no matter what I do, and the reason I'm saying this, I always talk about myself personally because it's just it's the example I know. But no matter what I do, I always hold a lot of cash. And so if, the economy goes bad for the business, well, we have a lot of cash. If my investments go bad or if I borrow money on a house and my interest rates go up, I got a lot of cash. One thing I've learned lately, and it would be my number one advice to so many businesses and people, is don't spend all your money. Hold the cash. Everyone's out there blowing money on crazy, stupid things and too many holidays and all this stuff. When the market turns or when things go bad, you're screwed if you do that.
Yeah.
Do it if you're making heaps of cash, but still you got to pocket your cash. You got to keep it somewhere. You need to have that safe haven. I think that, and that's, I'm sure when you have a fund, not being too, I'm sure holding a lot of holding the right amount of cash would be a big part of your strategy, no? The only problem is then you can't make money off the cash that you've raised. So how do you actually manage that?
It's a balance. And it's interesting what you said about 2015 to 2020 not holding as much cash, and then you get those battle scars essentially, which changes your psyche and perhaps makes you a little more risk averse. I think that's similar to investing in that you make mistakes. No one has a perfect hit rate. When you're a public equities investor, you will have stocks that go down and lose out. And then you kind of reflect on that. And then you try to enact process improvements to not make those mistakes again. In terms of holding cash, we have what's called a net exposure. So if you're at 100% net exposure in just a long-only fund, you've deployed all your money. And so it's a balance between, as you alluded to, wanting to be fully invested to take advantage of these great businesses and the growth that they offer. But then there are times where the market can get ahead of itself. And so you do want cash because cash provides option value to then deploy it at a better time if the market does dislocate. And so it's tough because timing markets, I don't think anyone can reliably do it. What we base that decision on is the opportunity set we see in front of us. And so when we're investing, we're underwriting each investment as a discrete opportunity where we are investing for an IRR, like a growth profile that meets our return thresholds. And to the extent that the price goes high enough that those return thresholds, those returns on offer compress and are no longer attractive, then we trim that position or we might exit it entirely. And if there aren't any other opportunities in our universe that are attractive, then we'll just hold cash. And so for us, it's a very bottoms-up thing as opposed to saying, or I don't know what might happen in, China might invade Taiwan or, the Israel conflict, whatever it is, there could be something that you're worried about. And you can very easily manufacture a scenario where market's going to crash the next month and therefore you should hold cash. But
I guess it's different for you because by you not deploying the cash you've raised, you can't make money on the cash you've raised. Yeah. Whereas if you were an investor of yours, if I had invested in you, well, I don't want to deploy all my cash into one asset class or into the stock market. I want to have a diverse, depending, but I would like to have a diverse portfolio of investments, plus not have spent all my cash on them, hold some cash.
Yeah, so typically the diversification happens at the investor level. They might be holding their own cash, and then when they allocate to us, we're their equities exposure.
Yes.
And so, a lot of the time they want us.
Yeah, because if they have no cash and they need money, they're going to call you up. Give me I need my investment back.
Right.
And that'd be bad for you, no?
Yeah.
Yeah. So you need investors that have cash or good cash flow.
Yeah, correct. It's the ideal person who's investing in Bristlemoon is, a high net worth individual or family office where they can give us something and
doesn't mean much.
It's not their life savings.
Yeah, that's the best way to do it. I even when I was raising capital for BOA, that's how I wanted to think about it. I was like, I don't want to take anyone's money who doesn't have money, basically.
Yeah.
I don't want to have that I don't know, it's not the responsibility. It's just you don't need to do it. It's harder to do it.
Yeah.
And the other thing is, let's say business owners, they're making a bit of money. They got profits coming through, their business is going well. They want to actually do something with that money. Now, one thing that I always see people do is invest in venture capital, other startups and other businesses. I've actually never seen that go well. that always, they invest in 4 different businesses, all of which are different than theirs, and then none of them do well, and then they end up in a bad situation. They invest in property, which, in Australia has always worked out well for everybody.
True.
But not that many people I know go into the stock market in a heavy way. So my question is, why would someone put more money into the stock market or a fund like yours as opposed to putting it into property?
I think the stock market as a whole, the reason why you invest in stocks is the compounding potential. And that's because if you find a really good business, the ability for that business to reinvest its earnings back into growth projects at very high incremental rates of return means that those businesses can compound at really, really strong rates. And as an equity holder, you're participating in all that upside. And, if you just look at equity markets, the market as a whole, on average, they're up probably high single-digit % over a long period. So that's a healthy return. But if you pick an active manager, you can, potentially get above that return because they are exercising discretion on picking really good businesses. And I guess, why would somebody invest in a fund like Bristlemoon? Well, I'm someone who's young, hungry. I've got alignment with all my wealth in the business. And
so if you screw it up, you'll screw basically.
Totally. Yeah. If I lose, they lose. If I win, they win. And I wouldn't have it any other way. I wouldn't feel comfortable taking people's money if I didn't have, all my money in the fund as well. So, we eat our own cooking and we're small and nimble. And so we can pivot to where the opportunities are. We're not a $10 billion fund which has size constraints. They can't invest in a lot of these businesses because it's not a big enough company to move the needle for their portfolio. And I'd say those are some of the key reasons. And then maybe something that's more subtle is having spent 5 years in New York, built up a good network of investor contacts. And so periodically I'll touch base with them and we'll exchange ideas and, I'll get healthy pushback, or even it helps with idea generation. And then with the newsletter, I have people sending, whether it's proprietary reports, it's their own insights on stocks that I've written up.
It's amazing. I've never ever met anyone, including myself, who doesn't say living overseas for 2 to 3 years wasn't the most important, best thing that they've ever done. It always provides a strategic advantage. It always provides motivation. It always provides an improved network.
It's the best thing I've done. Yeah. Going to New York for those 5 years was an unreal experience.
Yeah. I always tell my family that was the best thing we ever. I lived overseas a long time, and same thing. But we do have to wrap up. You've been awesome. Thanks, George. I really appreciate that. And, we love having you a member of CUB. We normally finish with like a book recommendation or something. I assume you read a lot.
I do.
I guess what would be your favorite book that you would recommend, whether it be in investing or not? What would be your favorite book?
In the spirit of this conversation, talking about the psychology of investing, one book that I've recommended to a lot of people and I've read multiple times is Influence by Robert Cialdini. And it talks about our own psychological biases and shortcomings and how if we're not careful and if we're not aware of those, we can be manipulated by them. And so it's a fantastic book. I recommend it to anyone.
Yeah, that's one of my favorite books of all time, actually.
Oh, that's good.
And to our listeners, if you want to get in touch with George, you go to cub.club/podcast and you can get his details there, along with the greatest lessons in business and other information. And if you want to catch up with Cub on social, it's at Club United Business on Instagram. George, thank you so much, man, for coming in today. And you're doing killer things. So good luck to you.
Thanks, Daniel.
Hope you enjoyed the show.